Most of the information you can find online is usually about retail trading. If you look for institutional or smart money trading, you won't find much about it. So today we'll talk about smart money concepts, a topic widely discussed among price action traders and popularized by ICT, known as the inner circle trader. So smart money trading, what is it? It's a style that leverages institutional trading methods to gain an edge in the market and avoid getting caught in the bank's liquidity traps. Institutions such as banks and hedge funds have significant influence on the market due to their substantial trading volumes. And as a retail trader, you should aim to align yourself with these institutional players. Think of these institutions as the whales in the ocean and us as the little fish swimming alongside them. You want to understand how they enter the market and follow their lead to ensure your safety and protection. Before we begin, let's first explore some key terms that will be used throughout this trading course. So smart money refers to the large players in the market, such as banks and institutions. Liquidity represents the pool of stop losses and pending buy and sell limit orders. Mitigation refers to the point where smart money breaks even on a losing position. Break of structure reveals the strength or weakness in a trend. A CHOCH represents a change in character in the order flow, indicating a possible trend reversal. An order block is an area where there has been a large concentration of limit orders waiting to be executed. A fair value gap is an imbalance in price created by a large order. It may sound complicated at first, but don't worry. These smart money concepts are not something new or invented, but rather revolves around classic principles of market structure, supply and demand, accumulation and distribution, and price returning to previous areas of acceptance. So let's begin with the market structure. Understanding market structure is crucial for analyzing and trading the charts effectively. It provides you vital information about the current phase of the market. In an uptrend, prices generally move higher over time. This is characterized by the formation of higher highs and higher lows. Each low point is higher than the previous one, indicating a bullish market sentiment. In contrast, a downtrend exhibits lower highs and lower lows. Each high point is lower than the preceding one, reflecting a bearish market sentiment. Lastly, a sideways trend or a ranging market is characterized by the absence of clear highs and lows. Prices fluctuate within a tight range, indicating indecisiveness among market participants. One of the most important aspects in the market structure are the shifts above or below previous swing highs or lows, leading to trend changes or continuations. The first concept is the break of structure. The break of structure plays a significant role in determining the strength or weakness of buyers and sellers. The break of structure is used to describe a significant price movement that surpasses a level of support or resistance on a chart in the direction of the previous trend. This is very important. A BOS is simply a break above a previous higher high in an uptrend, or a break below a lower low in a downtrend. I must admit that the break of structure terminology used by ICT confuses me a bit. This term doesn't imply a continuation in a trend. Maybe I got this wrong. But anyway, in an uptrend, when you see a market making higher highs and higher lows, you mark the most recent swing high. And if you have another impulse move closing above this point with several candles, then you found a BOS. In a downtrend, when you see a market making lower lows and lower highs, you mark the most recent swing low. And if you have another move closing below with several candles, again, you have found a BOS. On the other hand, a change of character, or a CHOCH, represents a trend reversal in the market after a break of highs or lows. A change of character describes a sudden and significant shift in the price action of a market. Let's take this market that has been in a downtrend, making lower highs and lower lows. Once the price breaks above this previous major swing high, this is a change of character that signals a possible reversal of the downtrend, as buyers have taken control of the market. If price continues to make new higher highs and higher lows, we've transitioned into an uptrend, and you start looking for BOS patterns once again. Here, price has been in an uptrend, making higher highs and higher lows. Observe the previous breaks of structure in the direction of the trend. Following this break of structure, the price reverses, forming a new lower low and signaling a potential trend reversal. After a minor pullback, the price begins creating lower lows and lower highs, indicating a new bearish trend. So price changed its trend, indicating a change of character in the market. The previous bullish trend has now shifted into a bearish one, and now you're looking for new BOS patterns in a downtrend. It's simple and easy, and you probably knew these concepts before with different terms. So BOS means continuation in the market structure, and CHOCH means reversal. In any case, this is how I see them. Now let's talk about fair value gaps. This ICT concept builds upon fundamental market structure principles, price action, and gap analysis. Fair value gaps are used to detect market inefficiencies or imbalances. Sometimes you'll see them labeled as inefficiencies. These imbalances arise when buying or selling pressure is significant, resulting in a large upward or downward move, leaving behind an imbalance in the market. So let's start by examining this chart. You'll notice that most of the time, when we have consecutive candlesticks, the price tends to retrace and leave wicks on both sides of the candles. However, in certain instances, we observe candles with no overlap on either side, like this candle with one candle to the left and one to the right. This phenomenon is what we refer to as a fair value gap. The idea behind fair value gaps is that the market will eventually come back to these inefficiencies in the market before continuing in the same direction as the initial impulse move. If you're familiar with supply and demand trading, it's the same principle. And if you are a price action trader, you can use these imbalances as entry or even exit points in a market. For a fair value gap to develop, there must be a set of 3 candles characterized by heavy buying or selling in the same direction. When there is a large move in either direction, a gap will be formed between the first candle's wick and the wick of the last candle, as you can see here. In this example, the price movement doesn't have a fair value gap, as the previous candle's high level has counterbalanced the low level of the third candle. This price action is considered to be balanced. The key lies in identifying these fair value gaps at levels that provide a trading edge or a strong signal. Specifically, you want to look for fair value gaps that coincide with a break in market structure caused by an impulsive move or a change of character. The area left behind by this fair value gap becomes an attractive region to seek entry opportunities on pullbacks. For instance, consider a market in an uptrend. As the price retraces and breaks below a significant swing low, the market structure shifts lower. We have a change of character, indicating potential short opportunities. Now, we keep an eye out for a retracement at a fair value gap that will allow you to enter short positions based on this shift in market structure. In the case of a bullish setup, the fair value gap operates in reverse. We witness an upward market movement, followed by a pullback, and another impulse move that breaks above the previous swing high. This breakout leaves a fair value gap between these 3 candles, with no weak overlap on either side of the middle candle. You then scout for pullbacks within this range to enter long positions. Identifying fair value gaps in the market can be relatively straightforward. However, if you need extra assistance, There are numerous free indicators available on TradingView that can help you in detecting these imbalances. I recommend you add this indicator by Nephew Sam. And I advise you to first focus on utilizing fair value gaps for trend continuation after a significant impulse move. As I previously said, you can anticipate the price to return to these fair value gaps before continuing in the same direction as the impulse move. You simply wait for price to reach the area of interest and then look for a trigger targeting a trend continuation. If the fair value gaps are wider, Fibonacci retracement levels can be used to refine your entry points. By drawing a Fibonacci tool from relevant swing points, such as the high or low of the fair value gap, the 50% level can serve as an alternative entry point. This approach ensures a tighter risk-to-reward ratio, although it may result in missing some initial entries if the price bounces before reaching the 50% level. Moving on to another example, let's now examine a resistance level on the lower time frame, such as the 5-minute chart. After breaking this resistance and undergoing an impulsive upward move, we see a fair value gap is left behind, providing a potential trading opportunity on pullbacks. Once again, it's crucial to identify them in areas where you expect retracements that align with the prevailing trend. Here, we witness a market that breaks below a swing low, signaling a short entry opportunity. A fair value gap is present in the area between this week low and this week high. Now let me address another concept that has gained popularity, namely the order blocks. If you followed my channel before, you'll realize that this concept is not something new, but rather revolves around principles of supply and demand and price returning to previous areas of acceptance. Banks use special orders for buying, selling, taking profit, or closing the orders. And when banks want to open a position with volume, they don't randomly place a position to upset the price and trigger their order at the worst price, because this may result in lowering their profits. So they try to split their positions into small, manageable blocks. A bullish order block is the last down candle or series of down candles before an upward impulse price move. A bullish order block will act as a support for the price to run higher. A bearish order block is the last up candle or series of up candles before a downward impulse price move. A bearish order block will act as a resistance for the price to run lower. Now, it's essential to understand that order blocks should not be identified everywhere on the charts, but rather in specific locations. You want to enter trades in areas where price retraces back into previous broken swing areas, providing the best risk-to-reward scenarios. In the case of a bullish order block, we observe a consolidation or a candle formation where buyers take control, absorbing the selling pressure at the bottom. This leads to a breakout above a previous swing high. We then look for a retracement back into the area where the price broke out, which serves as a potential entry point. Similarly, in a bearish order block, we have a market trending downward, followed by a consolidation. A downward impulse move breaks the market structure to the downside. We then wait for price to retrace back into the release point or the area just before the move occurred. This becomes an opportunity to enter short trades, placing the stop loss above this swing high. These are basically the rally-based rally and the drop-based drop formations in supply and demand trading. You target these order blocks for continuation trades in the direction of the previous trend. Now, it's worth mentioning that fair value gaps often align with order blocks. While these two concepts are closely related, fair value gaps tend to provide earlier entry opportunities compared to order blocks. When an order block forms with a fair value gap to its right, This makes it a high probability order block. And when an order block doesn't have a fair value gap to its right, this makes it a low probability one, and the price tends to run the stops below or above the order block. Order blocks are also formed when the market transitions from an uptrend to a downtrend and vice versa. A bullish order block or a drop-based rally demand zone will be found when the market changes from moving down to moving up. A bearish order block or a rally-based drop supply zone forms when the market reverses from moving higher to moving lower. Now, let's consider a downtrend. One of the steps mentioned by ICT is the violation of a previous swing low before the upward push and the confirmation of the breakout above the swing high, the change of character. This price move traps traders who were on the wrong side, adding fuel to the buying pressure. When price returns to the order block area, sellers who were trapped in their positions look to close out their trades, further fueling the buying side. Additionally, traders who missed the initial rally are drawn to this area, perceiving it as an opportunity to enter, resulting in an upward continuation of the trend. Here's another example involving a bearish order block. The recent market structure indicates an uptrend. Price formed a new swing high, declined, then formed a swing low. Prices then rallied again to exceed the previous swing high. This is a BOS. Price then fell to form a new lower low, a change of character this time. The previous move trapped buying traders on the wrong side. As prices start to rise again, you need to find an order block. And when price returns to the order block area, buyers who were trapped in their positions look to close out their trades, further fueling the selling side. And additionally, traders who missed the initial down move get their chance to enter, resulting in a downward continuation of the trend. For more precise entries, especially on higher time frames, if the order block has a wider range, Fibonacci retracement levels can be used, particularly between the 50, 61, and 78% levels. Depending on the context, you may focus on the candle body or include the wick as well when you draw the order block. Just remember you need to find the last bullish candle before a down move and the last bearish candle before an up move. To me personally, order blocks are the same as supply and demand zones. They represent areas of high volume accumulation before a major move occurs. But whatever you call them, these are high probability areas to initiate trades from. Understanding liquidity is a fundamental concept in smart money trading. Liquidity acts as a magnet for price, as price is constantly in search of a place to transact and either accumulate or distribute positions. Liquidity refers to the presence of orders at various price levels. These orders influence the price movements, often causing highs and lows in the market to be breached. So where does liquidity form? We can identify older highs and previous lows as liquidity points. Equal highs and equal lows are other liquidity areas. Liquidity can be found along trend lines, within chart patterns, at support or resistance levels. Essentially, liquidity refers to pending orders placed above or below these points. So your goal is to understand the major areas where liquidity is concentrated. First, analyze the trend. Where is the price currently? Where has it been? And where it might be headed next? When you ask yourself where is the price, there should be three possible answers: at a premium, at a discount, or at a mean. When you analyze about where the price has been, you can identify its origin, pinpointing the major swing points that led to its current level. Finally, when considering where the price is going, you have a few options. It could head toward a significant liquidity zone, or a supply and demand area, or an order block. Keep in mind that liquidity is continuously generated. When examining liquidity, you can view it as a reason for markets to move higher or lower. For instance, in a downtrend with a clear trend line, you can interpret it as a potential reason for prices to head higher in the near future, despite their current downward trajectory. Price enjoys creating liquidity, moving through existing liquidity, and generating more liquidity along the way. To simplify this concept, let's consider a trading range. Below the support level, you can expect to find stop-loss orders placed by buyers. Above the resistance level, there will be stop losses of sellers. If the market breaks below the support level, new sell trades will be triggered, while a break above the resistance area will activate new buy trades. In this context, liquidity refers to the collection of orders present on both sides of the market within the range. Buy-side liquidity represents the presence of buy-stop orders, which are placed above the resistance level. These orders are followed by the stop-loss orders from sellers who have entered their positions below the resistance level. The activation of buy-stop orders and the triggering of stop-loss orders will lead to an influx of buying liquidity. Institutional participants, who often have substantial positions to sell, require liquidity in the form of willing buyers. By pushing the market above the resistance level, they can access this liquidity, which results in their significant selling orders being executed. On the other hand, sell-side liquidity mirrors the same principle, but in the opposite direction. In a range where the lows form a support level, buyers are present at multiple levels, with stop-loss orders below this area. Below the support level, there are also sell stop orders waiting to be triggered if the market continues to decline. When the market pushes lower, these sell stops and the stop-loss orders will form the selling liquidity, and the accumulation of these selling orders provides an opportunity for a participant with significant buying power to enter the market, potentially causing a reversal and an upward rally. Remember this, for big institutions, opening large orders in the market requires reaching these liquidity points, and understanding buy and sell side liquidity can provide insights into the intentions and actions of institutional participants. As a retail trader, if you frequently experience stop-outs due to small price movements, it is likely because you are providing liquidity to large market players. In this example, you can clearly observe the formation of buy and sell side liquidity. The market often breaches both sides of the range, triggering buy or sell orders and stop losses, which leads to substantial price movements. By understanding these dynamics, you can incorporate this knowledge into your trading strategy or gain a better comprehension of the market movements. So start studying historical market data and conduct your backtest so you can witness yourself the significance of this concept. Whether you develop a trading system centered on liquidity or use it to avoid entering trades at major support or resistance levels that are likely to be breached. Now let's talk about the concepts of discount and premium. It's a simple concept where we mark out a range or a swing using a Fibonacci retracement with only the 50% level marked. When you mark premium and discount areas, you have the choice of selecting any major leg of price action or range on the chart in front of you. The line in the middle, the 50% level, represents the fair value. The premium and discount concept is straightforward. You aim to sell when prices are in the premium range, meaning you sell at higher prices, and you buy when prices are in the discount range, which corresponds to the lower 50% of the range. First, let's explore the discount and premium during a break of structure or a change of character. To place the fibs, you need to locate where the market experiences a break in market structure. Once you identify that point, it becomes your reference for applying the tool, and you mark it from the low to the high of that range. Now, if you are looking for a long entry, you should focus on areas that are not in the premium or above the 50% Fibonacci level. For instance, if you have a fair value gap or an order block right here above the fair value line, you wouldn't consider it for a long entry. Instead, you would concentrate on this area for potential long positions. Similarly, if you observe a shift in market structure or a change of character followed by a retracement, you would be interested in shorting above this middle line. You draw your Fibonacci retracement from the high to the low, and the shorting zone would be in the premium area. To be honest, there is nothing new here. If you're familiar with Fibonacci retracement, you already know this concept. I consider the premium and discount concept a great tool to use it as a confluence, but being overly reliant on it can cause you to miss good quality trade setups just because they aren't in the premium or discount. And as a tip, price tends to trend and respect the premium and discount in the longer term rather in the short to medium term. Another ICT concept is mitigation, and this is how I define it. Mitigation is the process of reducing losses or offsetting unfavorable positions in the market. The concept of mitigation can be visualized by combining it with the market structure analysis. So let's consider this upward trend. It means there are buy orders pushing the price higher. When we see a break in market structure or a change of character, such as breaking the previous higher low, it indicates that more sellers are entering the market. This doesn't mean that the market will immediately go down significantly, but it does suggest a temporary bearish sentiment in the market. Now let's consider the role of banks and institutions. Due to their size of their orders, they can't buy or sell randomly at any given level. They often need more time and multiple revisits to accumulate or distribute their positions. And don't think that smart money have perfect entries or strategies. They are susceptible to losses, as we are. They might have buy positions for this price move and sell positions in this wave. To mitigate this loss, the market may return to the previous level or even slightly higher before continuing the downward move. This action allows institutions to mitigate their buy positions and stack sell positions, effectively reducing their risk. They continue to accumulate or distribute sell positions, pushing the market further down. This is how I view mitigation. It involves mitigating losses from previous positions, entering new sell positions, and pushing the market in the desired direction. The goal is to bring the price back to a fair value and continue the downward movement. I personally prefer the 4-hour and the hourly timeframes, but feel free to use lower or higher timeframes based on your preference. To begin, you need to identify recent market structure. If we analyze this move, we can observe a higher high than the previous high, followed by a pullback and a new higher high. Now, this higher high was created starting from this previous higher low, which is located right here. If this level gets violated to the downside, we can expect a potential return in this area, possibly slightly above it, before the market continues its downward move. Once you witness this break, indicated by a strong candle, we can start looking for potential selling setups. Focus on the fact that those who continue to hold long positions from the previous high would be at a loss at this point. They would want to mitigate that risk by initiating sell positions. This is a subject for another video, but you can switch to the 1-hour time frame or zoom in further on the 15-minute chart to closely examine the price action. After breaking the previous level, you would anticipate a retracement to the upside. You'll often see bullish momentum on lower timeframes, inducing traders to go long. However, it's crucial to understand that this is part of market manipulation. As price reaches back up, you look for short opportunities. In this case, you are capitalizing on the market's manipulation and the potential loss mitigation efforts of those who held long positions. Now, all these smart money concepts will help you to read the market better and make better decisions, but they are missing one important piece of the puzzle, and that is the volume. Trading without volume is one of the biggest mistakes you could make. I highly encourage you to watch one of these trading courses next to learn more about how to add the volume component in your strategies. And check out our Academy program if you want to further level up your trading. Until next time.